Are we seeing the early signs that the COVID-era housing bubble is finally going bust? Already, April and now May make for the worst start to the housing season since 2009. Existing home sales, they cannot get off the floor, even though the number of available for sale homes has risen sharply. In fact, because the number of homes available for sale has risen, prices are starting to be depressed, especially in places like Florida, which is the housing canary in the real estate coal mine. And in key markets here in Florida, prices are already falling as the bubble busts under the weight of a bad economy. To begin with, no one seems to want to ask the most obvious question. After years of complaining how there were no homes available for sale, why are there suddenly the most in 5 years? There are indications it's institutional investors too who are the ones heading for the exits. In fact, the entire real estate puzzle is easily explained by small e economics. Prices are weakening and even falling in some places because there are now more sellers than buyers. What eludes most people is why. 20 years ago, the possibility of real estate bust was mainly about credit and mortgages, too much debt. This time around, it's macro, as in not nearly enough jobs and incomes. The housing market is yet another key indication showing how the economy is far from solid. In fact, we have yet another Federal Reserve official coming out saying she backs a rate cut in July. Why? Because like Christopher Waller last week, it's weakness in the labor market. Michelle Bowman today went on record with a speech and said, I favor a July rate cut. Consumer prices are not showing up in tariffs, but, quote, weakness in jobs and incomes might soon become more salient given recent softness in spending and signs of fragility in the labor market. The signs of fragility are all over the economy, starting with the housing market. With oil prices coming down today on hopefully de-escalation in the Middle East, we've got market interest rates that are dropping all over the yield curve. The 10-year U.S. Treasury is down to 4.3%, and more importantly, the 2-year, the fundamental 2-year at 382, if it holds there the rest of the day, that would be its lowest since early May. Even Federal Reserve officials like Bowman and Waller are getting on record with what I told you yesterday with Steve. The Fed is going to cut in July because the economy is not strong and resilient. It is not even solid, and that starts with jobs and incomes. And jobs and incomes are the two things that determine the state of the housing market. When jobs and incomes are actually robust, not just in the characterization of Fed officials, when they're actually strong and resilient, people will buy homes, and they will do so regardless of interest rates. Nobody wants to pay high interest rates, but if you find a house you really like and you are very confident in your job and your income prospects, you go out and you pay the extra price because that is something that you really want. You really can't put a price on having the house that you really want to live in. But the housing market here in the United States, it did not start out well. Spring is when housing really starts to bloom, but as Bloomberg reported, April is normally when transactions kick into overdrive, warmer weather drawing in buyers and sellers alike. But this year, the number of signed contracts was the lowest for the month since the COVID lockdown in 2020, at least according to seasonally adjusted data from Redfin. Deals were down 3% from last April, already seen as a low mark, so going lower than the low point. Active listings for April also ballooned to the highest level since 2019, suggesting homes are piling up on the market. And annual median price growth measured by completed purchases was just 1.4% compared with an almost 6% gain recorded in April 2024, which was supposed to be the low point. This spring is sort of a whimper, said Redfin senior economist Bokhari. You're on that low bottom level of activity for the foreseeable future until something definitive happens with economy and then throws in their rates. You're not supposed to say the first part, and almost no one else will. Something definitive happens with the economy, meaning it actually turns around. But everything from here on will refer to interest rates exclusively, trying to explain this housing market macro puzzle. It's not actually a puzzle. It's all about jobs and income. Jay Powell is wrong, and even two Fed officials are starting to realize the possibility he is wrong about the solid labor market has grown way too uncomfortable. Now, before we get back to the rest of today's video, I want to tell you about today's video sponsor. We talk all the time on this channel about the dangers the world is facing, trying to come to grips with the aftermath of the pandemic and the lockdowns, the difficulties associated with the supply shock and price illusion, not to mention still living in the shadow of the 2008 crisis. To put it mildly, there's a lot of systemic uncertainty. Now, I've recommended gold as a store value hedge for years. In fact, it's the ultimate error hedge. While gold prices are at an all-time high, price appreciation isn't the only way to profit. You can earn a yield on gold paid in gold without selling your metal. When the price of gold increases, so does the cost to store it and insure it. Don't lose money owning gold, earn a yield on it instead. And Monetary Metals allows you to earn up to 4% on your metal in their gold leasing program. And you start earning that 4% yield immediately upon funding your account. The yield you earn is paid in ounces of physical gold or silver, which you get in addition to any price appreciation from gold and silver during the year. So join the thousands of investors earning interest in physical gold and silver every month with Monetary Metals. There's a link in the description of this video that has all the information that you need. We thank Monetary Metals for their sponsorship, and now back to the rest of this video. And what was reported this morning was that it wasn't just April. April, maybe you can forget and say, okay, there's a lot of chaos in the marketplace, stocks were down, liquidations, all that stuff, fears over tariffs and trade wars. But here in May, we've got the trade delays, we've got the stock market rebound, consumer sentiment is rising a little bit, rebounding from the bottom. Yet, in the housing market, there was only a very small increase off of last month's levels. According to the National Association of Realtors, they reported today that the total volume of existing home sales or resales hit a seasonally adjusted 4.03 million in the month of May 2025. That's down 1.9% from last May, which means, again, the worst start to the housing season since 2009 wasn't just a single month, it's now 2 months and counting. Going back to Bloomberg here, U.S. previously owned home sales rose slightly in May to a still sluggish pace that continues to show a housing market constrained by poor affordability. They use that term. It's another euphemism that really means jobs and incomes. It was the weakest May sales pace since 2009. The resale market, which historically makes up 90% of total home sales, looks set to languish for the foreseeable future without some let-up in financing costs or downturn in prices. Again, it's actually jobs and incomes. And for the longest time, especially economists and experts in the real estate sector said, well, one of the reasons why resale activity has been so low is because there's not enough homes for sale. Well, that part has changed more recently. Going back to Bloomberg. In May, inventory increased 6.2% to 1.54 million houses, the most in nearly 5 years. Still, the growing number of homes on the market hasn't jump-started home sales, which everybody said it would, evidenced by the weakest start to the spring season in 5 years. Inventory, inventory, inventory. That's what they all said. Suddenly we got inventory and sales aren't budging. First of all, you got to ask the question, why are suddenly people so ready to sell their homes after being unable and unwilling to do so for the last several years? Could it be because people are starting to sense that they can't afford the house that they're in, that maybe their mortgage payments are actually too high given the income situation, the precarious shape of the jobs market, as well as the potential for more rising costs that they can't afford in necessities? So it's another part of small e economics where suddenly homes for sale doesn't line up with rising activity, it lines up with weakening prices. Maybe Americans are trying to get out of houses they can't afford, and that the rise in inventory, rather than being a positive, is another side of the economic negative. And even Larry Young, who's the head economist for the National Association of Realtors, was asked if maybe it's investment funds that are doing the selling, because they're looking at the housing market and seeing the macroeconomic fundamentals from the inside perspective and saying, we better get toward the exits. We better get out of Dodge before the housing market really does tip into something even worse. That's a growing possibility too, that the institutional investor is doing more of the selling and that the rise in inventories is, as I said, not a positive for the real estate market. It's a negative reflection of the macroeconomic fundamentals. But you go back a year to June of 2024. Again, Larry Young, the head economist for National Association of Realtors, he said, more jobs mean more home sales and higher housing demand. You need a strong local economy for a strong housing market. And then he added high mortgage rates and a lack of inventory were a shock. There's that inventory excuse. And not all housing demand is being satisfied due to a lack of supply. But he said demand was going to be robust because you had solid growth in income, growth in jobs and incomes. Plus, there's this inflation fear that the Federal Reserve was talking about a year ago, sticky inflation. Therefore, that would put some support under demand for housing. What Yun said last year was, we had a massive budget deficit while experiencing a good economy, meaning low unemployment. People may get used to permanently high inflation. That's expectations theory that comes straight from the Federal Reserve. And people will be looking for an inflation hedge. Real estate is proven. So basically, Yun on the economy, all he does is repeat Fed talking points. And if Jay Powell says the economy is solid and strong and they're at risk of inflation because of expectations, then that's exactly what Yun says. That's what all these mainstream credentialed economists will say, the same thing at the same time. Whatever the Fed says, just write it down and repeat it. But Yun got that one part right. You need a strong economy for a strong housing market. It wasn't the lack of inventory that was holding back the home market. It was the lack of economy. But not according to Larry Yun today. After the release of the NAR's estimates, he says, increasing participation in the housing market will increase the mobility of the workforce, and now it's going to drive economic growth. If mortgage rates decrease in the second half of this year, expect home sales across the country to increase due to strong income growth, healthy inventory, and a record high number of jobs. And it's the other way around. Jobs lead to housing. Housing doesn't lead to jobs. He had it right a year ago, but now has to come up with a new excuse and now says, well, the housing market is a big provider of jobs. That the housing market raises the mobility of the labor force, therefore makes it less rigid and helps contribute to a healthy economy. When instead what we're seeing is that it's a reflection of an unhealthy economy. But moreover, we're conditioned to believe that interest rates are everything. And that comes from the Federal Reserve. And as I mentioned in a Make It Make Sense video last month, this emphasis on interest rates is simply because that's the only tool the Fed has. And so they repeat ad nauseum this idea that interest rates are the most powerful, most important instrument in the entire financial world, and the Fed wields it with precision and skill. But here's the thing. If your income growth and everyone's income growth is really solid and job prospects overall are very good, and you find the house that you really want, you're not going to care if interest rates are 6.5% or 4.5%. You don't want to pay 6%. Nobody does. Nobody wants to pay more. But if your income prospects really are strong, then you buy the house and pay a little bit more to do so. If, however, you know incomes aren't really keeping up with the cost of necessities that's as it stands today, and the job market is far from sound, let alone strong, there's no way you even think about buying a house, even if you do find one you absolutely love. And it doesn't matter if the interest rates are 6.5% or 4.5% or something else. Economists want to make this about interest rates when it's really not. It's about jobs and incomes. In fact, when we're talking about the rental market, which is a big part of real estate and housing, I had a discussion with Kenny McElroy on his channel last week. And we're talking about the rental market and his view of the situation. If you're not familiar with Ken, you should be. He's a big-time real estate investor, especially in apartment projects and apartment communities. And he said the income quality and credit scores of applicants has substantially dropped off. People are really struggling, which fits not just his corner of the real estate market, renting apartments. It also goes for the entire property sector overall, and the entire economy for that matter. So if you've got weak jobs, weak incomes, nobody's going to come buying, even if there's more houses for sale. Again, there's still a question about why are there more houses suddenly for sale? But with that imbalance between too much supply now and not enough demand, sales prices are going to soften and weaken. According to the National Association of Realtors, the median sale price in May for resales was just $422,800. And while that's slightly higher than last May, it's only up by 1.3% year over year, which is the weakest year over year rate in years. In April, it was 1.8%. And you go back to last December, the artificial high, it was 5.8%. So substantial deceleration when here in 2025, as the overall macroeconomic situation has gotten more and more, well, they say it's more and more uncertain. That's what everybody says, along with interest rates explaining the housing market. The economy has instead gotten more and more certain, not less certain. In fact, we know that because of Christopher Waller and Michelle Bowman suddenly saying, Yeah, we're going to cut rates in July. The Fed is going to cut in July because the economic fundamentals, small e economics, demand it. We're seeing them here in the housing market. And there's another possibility too. We've got the other side of the COVID era bubble. Now, the COVID era bubble back in 21 and 22 was built on assumptions the economy was going to be strong and actually recover. It was red hot, they all said. And the labor market was there was a labor shortage. Income growth was going to be forever into the future. So how many more signs of labor market weakness do we really need before people realize that's the problem here? Jay Powell's job, pun intended, is to get you to not see how jobs are not there. And the Florida market is a warning, especially to the COVID era bubble properties going bust, because this is where those bubble properties were seen the strongest. And not just seen and said, but also producing just a huge distortion in the marketplace and prices, as well as building an activity that in 2025, with the national economy, with the entire global economy that's not recovering, it leaves the small e economics in this shape. We see it on the other side too in terms of construction and new home sales. According to the Census Bureau's latest estimates for the month of April, it's 1 month further behind. We'll get the May figures this week, I believe on Wednesday. For April, the Census Bureau actually reported a pretty substantial rise, more than 10% in new homes sold to 743,000. It's a seasonally adjusted annual rate, which is the highest pace since 2022, but that came after some big time lows to start the year. And what was being sold was more cheaper houses. This is a phenomenon we see all over the place. More cheaper houses are selling. There's growing evidence that the housing market's really struggling at the upper ends, the upper tiers, which are usually where the housing market gets its most support. Despite the increase in new home sales pace, the median price was down 2% year over year in April compared to last April, after being down 7.5% year over year in March. And what we've seen from new home sales is that builders continue to offer concessions, price concessions and other forms of concessions, just to keep up on minimal volume, because even 743,000 is not a huge amount. With all this hype about how strong the labor market has been the last couple of years, it is not translating into new home sales, which of course everybody blames on that's the high interest rates. Well, like anything else, including consumer prices themselves, if incomes and jobs were growing at the rate consistent with the rhetoric, then people would not care about the interest rate. If prices zoomed ahead by 10%, but your income rose by 15%, you don't like that prices are up 10%, but you easily absorb it and you continue on your way. Same thing with housing prices. Even if interest rates are up and home prices are up, if your income grows more than enough to make up the difference, the buyers would be there in the market. Interest rates are not the most important factor here. The economy is, the labor market. It seems to be a factor that's really showing up in terms of future construction. Developers may have sold a few more homes in April, but they are not optimistic by any stretch of the imagination. What we saw from construction data, permits and starts in the real estate sector, these are for the month of May, total permits dropped under 1.4 million seasonally adjusted, which was the first time below that level since June of 2020. So developers are filing fewer permits, expecting that this is not going to go better. This is not going to suddenly increase. The buyers are not just going to materialize out of the woodwork, as the NAR chief of propagandist Larry Young said. Starts fell to 1.26 million, which was the lowest since May of 2020. We're seeing weakness in the single family space, as permits there were below 900,000, therefore the lowest since April of 2023, the aftermath of the banking crisis, while starts slid to 924,000, and they've been down in this March through May period that we keep seeing economic weakness show up all over the place. And in the multifamily space, continued weakness there, been weakness for well over a year. Even though you'd think that if the single family part of the housing market wasn't going to rebound, then that would mean that there would be a rush of demand for apartments and new apartments. But we've got COVID era bubble properties on that side of the marketplace. Plus, as I just mentioned with my conversation with Ken, there really aren't enough qualified potential renters to make it worthwhile to start the expensive, cash-intensive process of building apartment projects and communities. So Larry Young was right in this one respect, at least back when he could blame low inventories for the housing market depression. What he said was a strong economy leads to a strong housing market. So if you don't have a strong housing market, then See, the most obvious answer, according to the mainstream, can't possibly be true because the Fed says so. So we have to blame interest rates, which makes it seem like the Fed is actually relevant. How convenient is that? And even so, they all still talk about affordability, which, whether they realize it or not, simply means jobs and incomes are not enough. The weak economy means most people can't afford housing at any interest rate, just like they're struggling to pay the bills on necessities. And with housing inventory finally rising, we have to ask the question why that might actually be. Is it institutions? Is it regular folks that can't afford houses that they're in? It's the same reason why suddenly Federal Reserve officials are going on record advocating for a July rate cut. And rate cuts, as we know, are a response to economic weakness. Buyers aren't showing up in the housing market because the economy isn't showing up either. And prices are shaky simply because so are jobs and incomes. I never make predictions because they're always wrong. But I made one, and a pretty strong one, in yesterday's video. To find out what it is, that's in the one link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.